This video talks about the second topic related to the question of why retail investors often lose money. It is about which stocks have the potential to rise. First of all, we need to know what the key logic of the stock rise. The answer is actually very simple, because there are only two modes in which stocks rise. Let's start with a formula. Then, on the premise that the total share capital remains unchanged, an increase in the market value is equivalent to an increase in the stock price. We all hope that the market value will continue to rise. From this formula, there are only two ways for the price to rise. First, the net profit has increased. The increase in the profitability of the company represents the increase in the value of the company's stock itself. Second, the pay value has risen. Market expectations for stocks have risen. In this video, let's talk about net profit first. Net profit is the company's operating income, after deducting various expenses and taxes. It is the money that the company can actually get in its hands. The increase in net profit represents the improvement of the company's profitability, whether it is the improvement of revenue capacity or the improvement of cost management. The final result is that the company makes more money. Since the company is able to make more money than before, more people will be willing to hold the company's stock. That's the secret of why the value of the company's stock is rising. In addition, you must be aware of the 4 different operating states associated with net profit. The first scenario is ideal, a company that can make money now, and we think it can make more and more money in the future, then the company is very attractive. In the second scenario, a company is currently making money, but it is estimated that the money earned every year in the future will be similar to this year, and there will be no growth. In this case, the company has stable cash flow but no growth ability. The above two scenarios are relatively positive. Let's look at the third one. A company is making a lot of money now, but in the future its business will shrink and it will make less and less money. In this case, it is not a good idea to invest in this company. Even though it is making a lot money now, but most investors don't like companies without a future. The last one, a company that does not make money now or makes little money, but it will become more and more profitable in the future. Such companies are more common in high-tech growth stocks, like semiconductors, renewable energy, and so on. In the next video, we will talk about the second way of upside potential.